Lecture 6, Adjusting Entries. Make sure that you've downloaded the T-Accounts handout for this lecture that's available on the online lecture resources page of the website. Okay, suppose a company purchases a brand new office building. And, they move into the building, maybe they have like a manufacturing floor on the bottom and they have offices on top. Maybe there's a retail location. They operate from that building for 30 years. By that time, they say, hey, we could really use a new building, something more modern. So they move out and they're looking for a new building somewhere else. All right, now think about the value they paid for that building when it was brand new. And think about the value 30 years later. Now, if we ignore inflation, what has happened to the value of the building after 30 years? Right? It should be less than the value of the brand new building. That's pretty much true with almost everything, right? When we purchase it and it's brand new, it's worth the most money. And then as we use it, the value goes down. If you've ever bought or sold anything on eBay, you know this, right? Brand new in package, with tags, that is the highest value. And if it's like new, only used once, well, that's going to be a little lower. And then the more it's used, the less value it's going to have. Right? So this is a common concept that we're used to. The idea that when something gets used, there is wear and tear on it, and it loses some of its value. So in accounting, we have this concept, and we call it depreciation. Right? So depreciation is the use, or sometimes the value used, of a long-term physical asset. So if we have an asset like a building and we use it for a while, well, we have used up some of the value of that asset because of the wear and tear and the stress that we have put on the building. You can only use something so much before eventually it breaks down. Okay, so let's see how we deal with this in accounting. So let's look at an example. On January 1st, a company purchased a delivery truck for $20,000. The truck was expected to last for 10 years. How does this impact the company's financial statements? Okay, now they purchased a delivery truck and they're going to use it for 10 years. Suppose they didn't purchase the truck and instead they rented a truck. Then they would have a rent expense that they would have on their income statement, right? By purchasing the truck, they don't have to pay rent, but they do have to pay to buy the truck. And then after 10 years, the truck's not going to have any value anymore, right? Because they will have used it, they will have worn it down, and it won't be worth anything. So there should be an expense that represents that usage of the truck over that time period. And that is the expense that we call depreciation. Now, just think about it logically. If they purchase the truck for $20,000, if it's going to last for 10 years, then how much value are they going to use up each year? Well, the obvious answer is $2,000, right? Let's formalize that. What we say in accounting is that the annual depreciation expense, so the annual usage expense, is the cost of the asset divided by the years of life. So what you probably just did mentally when I asked you, right, instinctively, is you said, hey, it's a $20,000 purchase price. It's going to last for 10 years. And so that's a $2,000 per year value being used. Okay, now we've calculated that there's an expense of $2,000 per year. So every year we're going to record this in a journal entry. And this entry is one of the adjusting entries, one of the ones that happens at the end of the year. So we use the asset for the whole year, and then at the end we record the entry. So we know we have depreciation expense. And expenses, even ones you've never heard of before, expenses are debited, right? They increase and they debit. So we have a debit to depreciation expense for $2,000. Okay. The credit goes to a new account, something called accumulated depreciation. And I'll explain in a few minutes what that means. Okay, so this entry is performed every single year. So for each of the 10 years of the asset's life, this entry will be done at the end of the year as an adjusting entry. Now, the question wants to know, how is this going to impact the company's financial statements? So we're going to start with the balance sheet. Okay, now if we look in the assets section of the balance sheet, we're going to see that truck listed. Okay? And then we're going to subtract the accumulated depreciation, and that will give us something we call truck net. All right, let's put some numbers in there to explain what's going on. So the truck is going to be shown at its original cost. Whoops, and somehow I had an extra column show up in there. There we go. Okay. The accumulated depreciation is $2,000. And so the value of the truck net is $18,000. All right, now I know this is a lot of weird and new stuff. I just kind of pasted it all in there. Let me explain piece by piece what each of these things is. Okay? So we said that the truck is $20,000 because that's the original cost of the truck. Okay? Now, if you remember, the historical cost principle requires that we keep assets at their cost, and we keep them at that cost until we get rid of the asset. Right? So we're recording the truck at $20,000. It's going to stay at $20,000, right? In fact, that truck is going to be there at $20,000 for this whole time period that we're going to have going on, right? So we're actually going to have, let's see if I can get this in here. And of course I can't, but it's going to be $20,000 for the entire time. There we go. We got one of them. All right. Now, the accumulated depreciation that is subtracted. I talked about depreciation as being the use. So what does accumulated mean? As an English word, accumulated means things that have piled up, things that have collected. So for example, I might have an accumulation of dust under my bed. I might have an accumulation of spam in my spam folder. I might have an accumulation of homework because I haven't wanted to do the assignments. Whatever it is, right, accumulated means it has piled up. So for depreciation, the accumulated depreciation is the depreciation piling up, right? It is all of the usage that the company has ever had from an asset, right? So accumulated depreciation is the total usage of an asset throughout its life so far. So in the first year, right, we finished 1 year of use, the accumulated depreciation is $2,000. But what is the total amount of use after 2 years in 2021? Well, after 2 years, the total use we've had is $4,000. And after 3 years, the total use we've had is $6,000. So accumulated means that we're letting it pile up. So it's not just 1 year's worth, we're collecting all of the years throughout history. Okay, now this total here, truck net, okay, that is the remaining value of the truck. Okay, it's what's left over after we take the cost, we subtract the usage so far, the 18,000 is what remains. So this is what we call our net asset. This is the final value for the asset that will be on the balance sheet, which makes sense, right? If we've used it for a year, it's not worth $20,000 anymore. It's worth something less. And we are saying we think that's $18,000. Now, this term here, truck net, this is something that you see in business, not just in accounting, but in business in general. We have this concept of net and gross. So for example, let's say that you have a job and you earn $1,000 salary every week. Okay? So you get to Friday, it's time for your pay. Do you actually get paid $1,000 at the end of the week? Unfortunately, that's not the way it works. $1,000 is what's called your gross salary, where gross means your total salary. However, that's not what you get paid because certain things have to be subtracted before you get your paycheck. So they take out federal and state taxes, they take out money for Social Security and Medicare, they might take out unemployment or other things. And by the time all that stuff is subtracted, the amount of money that you get, you're going to be lucky if it's $750, might be less. But the amount that you actually receive is your net pay, right? It's after those things have been subtracted. So we have this concept in business in general of a gross item, which is the whole amount, and the net amount, where the net amount is the value after certain things have been subtracted. So that's exactly the meaning we're using here. This $20,000, that's the gross value of the truck. The $18,000 is the net value after the $2,000 of accumulated depreciation has been subtracted. Okay? Sometimes this is also called the net book value. That's the more formal term for it. Book in accounting means the accounting records. Remember, accounting is 500 years old, right? So a lot of the terminology comes from before there were computers. And back before there were computers, literally accounting was done in books, right? There were these big books called journals, and we'd make entries in the journal, right? But there were these big books and accountants would work with them, and that's where they keep all the records. So we still have a lot of that terminology around today, where we talk about the accounting books, meaning the records, even though the records are now kept on a computer system somewhere. Or we talk about, what's the value on the books, or, are you cooking the books, which means are you falsifying the information in there? There's all kinds of terms that relate to books. So in accounting, book means the accounting records. So the net book value means the net value in the accounting records. So that's a term you'll see used. Okay, now what happens to this net book value? As the life of the asset goes on, right, the accumulated depreciation increases, and so the net value of the truck goes down. So if we just get the whole thing here. All right, so we can see that the value of the truck is going down by $2,000 each year. I'm going to stop here at 2022, but you can imagine if I did the whole 10 years, this net book value would eventually go down to 0 at the end of the 10th year when it has been fully used. Okay, so just to repeat, the value of the truck is the original cost. Right, the accumulated depreciation we said is the total usage of the asset so far in its life, and the truck net is the remaining value. And of course, we call that remaining value the net book value. All right, now the only thing I haven't really discussed is what kind of account is accumulated depreciation, right? I'm saying on the balance sheet with assets, we have a subtraction right in the middle of the assets section. I mean, that's weird. We have not seen that before. And the reason for it is because accumulated depreciation is a special kind of account. It is known as a contra account. Now, there aren't very many contra accounts. I think we're going to learn about 3 of them throughout the entire course. There are only a small handful of such accounts. But these accounts have special characteristics, and because of that, they're treated a little bit differently. So the first characteristic of a contra account is that it has a partner account. So a contra account is never alone. It has a partner account, and it's always with that partner. So, you know, couples in love. We see them sometimes, but, you know, around Valentine's Day, they always start crawling out of the woodwork. But there's always that one couple that you know that's sickeningly in love, right? The couple that's just always together. They're always looking into each other's eyes and calling each other little stupid pet names like Schmoopy or Hugglebunch or something like that, right? That's the couple in love. And they're always, always together. You can never get one of them on their own, right? They take the same classes. They're always together. You secretly think maybe they even use the bathroom together because you just never see them apart. That's how the contra account is with its partner. They are always, always together. So the contra account is, of course, accumulated depreciation. Its partner is the truck. So the accumulated depreciation is in love with the truck, and the truck is in love with the accumulated depreciation, and they go everywhere together. Now, in most couples, there's one partner who is a little bit dominant, right? They're the ones that say, yes, we're going to do this and we're going to go this place and this is the plan. And the other one says, okay, we'll do that. Okay, in this partnership, the dominant one is the truck. The truck is the one that has responsibilities, that has places to be. The truck says, hey, there's a balance sheet and they're putting together the assets section. I need to go in there. And the accumulated depreciation says, okay, you go, but I'm going to come and I'm going to sit right next to you. Right? So this is the partner relationship, right? We are putting these two together. They're going to be next to each other. And it's not just when making the balance sheet. It goes whenever you're listing accounts or anything else like that. Give you a little sneak peek. Later on in this lecture, we're going to be doing some journal entries here and T accounts. And I have an apartment building. And you notice with the T accounts, the apartment building is right next to its accumulated depreciation, right? Even in the T accounts, they have to be next to each other. So that's the partner relationship. They're always together and they are in love. And just like real couples who are in love, sometimes the two are not just there holding hands, they physically express their love and join together and they become one. And sometimes you won't see them separately, you'll just see them combined together to become one. But they will always be together. So that is the partner account characteristic. So every contra account has a partner account. Now, what's the other characteristic of a contra account? Well, not only do they have a partner, but they are opposite from that partner account. This is where the word contra comes from. It's Latin, it means against. So the contra account, in this case accumulated depreciation, is opposite from their partner. Now, in the real world, we know couples like this, right? One of them loves sporting events and going out and drinking beer and listening to metal, and the other one just wants to stay home and knit and listen to opera, right? Total opposites, but somehow they make it work. right? So that's what accumulated depreciation is like with the truck, right? They are opposites. Now, in the real world, there are many ways to be opposites, but in accounting, there's only one set of opposites. What's the one set of things we've learned about that are opposites from each other? And that's debits and credits, right? Debits and credits are opposite from each other. So let's think about it. The truck is an asset. And as an asset, that means it is a debit. But the accumulated depreciation, right, it is a credit account, right? We can see that right here in the journal entry. We're crediting accumulated depreciation. So the accumulated depreciation is a credit. That is the opposite of the debit. And that's why it's being subtracted right here. It's not that we arbitrarily said, let's subtract the accumulated depreciation. No, the reason it's being subtracted is because we have a credit applying against a debit. Right? Now, overall, the end result for the truck net is still a debit. That's because there's more to the truck than the accumulated depreciation, but this is the opposite aspect. Right? The contra account is the opposite direction from its partner account. Okay, so the accumulated depreciation is a contra account. Right now, that's the only contra account we know. There will be a couple of others that I introduce throughout the course, and I'll make it very clear when we come across them. So for the test, this is the only contra account we know of. Okay? All right, so that's what happens on the balance sheet. What about the income statement, though? So let's say we are preparing a company's income statement. Now, on the income statement, we have revenues minus expenses. So that's what we're going to have here. But one of those expenses is going to be depreciation expense. All right, now, let's take a look at 2020 here. How much depreciation expense does the company have in 2020? Well, it's $2,000, right? Now, let's look at 2021. Now, remember, with the income statement, we talked last time about how we have the revenues and the expenses matching together so that we have the most accurate calculation of profit. So when I'm preparing the 2021 income statement, I only want 2021 revenues. And I only want 2021 expenses. That's how I'm going to calculate the most accurate version of profit for 2021. I don't want anything from 2020. I don't want anything from 2022. Those are going to mess things up. I just want 2021 all by itself. So for 2021, all by itself, how much depreciation do I have? Well, the answer is for just that 1 year, $2,000. All right, and then what about 2022? Let's say I'm trying to make my income statement for 2022, and I want the depreciation expense just for 2022 and nothing else. Okay. Well, what I'm going to want is another $2,000. All right, so we don't obviously have the net income because in this question I didn't give you the revenues or any of the other expenses, but you can see that each year the depreciation expense is $2,000. Now, sometimes students come to me and they say, why do we have two different depreciation accounts? Right? And the answer is because they look at two different things. The depreciation expense, right? Expense for the income statement is 1 year at a time. We're only looking at one single year, one single year, one single year. So it's for that year only. But the accumulated depreciation is when the depreciation piles up. We're looking at all of the years throughout the asset's life so far, right? So that's why we have two different accounts that we're going to look at here in the journal entry. This first one, the expense, records that 1 year only. The accumulated depreciation, that's the amount that's piling up in the account every single year. So that's why we have two different accounts. Okay, one last thing before I leave depreciation behind. I said that depreciation expense is the value or value used of a long-term physical asset. So physical assets that last for multiple years are depreciated. That means stuff like equipment, machinery, buildings, vehicles, computers, mobile devices, all depreciated. There's just one exception. There is one asset that lasts for many, many years that is not depreciated, and that is land. So it's important to note that this depreciation applies to all those assets except land. And the reason it doesn't apply to land is because land will always be there. Right? I know over in Pacifica, there are some houses, and every year during the winter, they show that the houses are falling into the ocean because the land's eroding. But generally speaking, we feel like land will always be there. And that means it has an infinite life. And for those of you who are into math, you can imagine this calculation here. If we take the years of life and take the limit as that approaches infinity, right? Well, then the amount of depreciation expense is going to approach zero, right? If the asset lasts forever, we're not really using up the value. So that's why we don't depreciate land, right? It's considered that it's going to last forever, and therefore we do not use up the value. Okay, so what I'd like to do right now is go through an example, and we'll talk about some of these adjusting entries, including this new depreciation that we learned about. So let's take a look at example 2. Betsy Service Corporation had the following situations come up during the December 31st year-end accounting work. So we're going to have to give an adjusting journal entry for each situation. Okay, so in A, on September 1st, Betsy collected $3,600 of cash in advance from a customer for a 1-year subscription to Betsy's services. Okay, so that happened back in September. Now, this question is looking at December 31st at the year end. So we're not looking at what happened in September. We want to know, what do we have to do now in December? But it turns out that what Betsy did in September impacts us right now in December. So let's see, what did they actually do in September? So in September, they received $3,600 of cash in advance from a customer. Now, last lecture, we learned that cash received in advance from a customer is called unearned revenue. So on September 1st, they debited or increased their cash, and they set up the liability of unearned revenue. Now, that happened back in September. This question that we're doing, the answer that we're actually supposed to give, is for December 31st. So what has happened between September 1st and now, December 31st, in order to make us have to do something? Well, what's happened is that Betsy has provided services to the customer. So they have earned some of this revenue. So just like we talked about last time with the streaming service, right, where they earned 5 months of revenue and they had to record it all at once. Well, Betsy has earned some revenue, and at December 31st, we're going to record it all at once. Okay, so how many months of revenue have been earned? Well, let's see, we have all of September, and we have October, November, and December. So that is 4 months of revenue being earned. So Betsy has earned 4/12 of this, right? It was a 1-year subscription, and we've earned 4 months of it. So that means at December 31st, we're going to decrease the unearned revenue, which is a debit, and then credit service revenue. All right, now the amount here is $1,200. How did I get $1,200? Well, what I did is I took the $3,600 that the customer paid, divided by 12 months for the 1-year subscription, and multiplied by the 4 months used. Okay. All right, so we talked about that last class, right? About what happens when we have to record earning multiple months at once. Let's try another example. Let's say that Betsy paid for $600 for 8 months of insurance in advance on June 30th. Now we're in a similar situation here, except instead of the customer paying in advance, Betsy is the one who's paying in advance. And we talked about this last lecture as well. When we pay for things in advance, that is known as a prepaid expense. Okay, so even though it's not necessary for the problem wants to know what happened in December. Let's just review what happened in June when Betsy actually made this payment. Well, Betsy credited cash, right? Decreased cash, and set up an asset for a prepaid insurance, for a prepaid expense. Now, how does that impact us in December? Well, since June 30th, Betsy has been using the insurance coverage. So Betsy has used up a portion of this prepaid asset. So what we're going to have to do at December 31st is we're going to have to decrease the prepaid insurance asset, decrease the prepaid expense, and we're going to record something else. What do we record when we use up an asset? We record an expense. So we'll also record insurance expense. All right, so here's what that looks like. So we've decreased the prepaid insurance, decreased the asset as we use up our prepaid value. And as we use up the asset, we record an expense. And remember, expenses are always debited, right? So that's what we're seeing here. Now, the amount I'm putting here is $450. How did I come up with that? Well, the $450 is the total $600 paid for the whole 8 months, multiplied by 6 months of use. How do I know it's 6 months? Right? Well, we paid on June 30th, so June's over, but we start with July, August, September, October, November, December. We have 6 months where we have used that insurance. So that's where the 6 comes from. You just literally have to count those months. Okay, let's try another example, something we might have to adjust at December 31st. C, at December 31st, Betsy had expenses of $900 that will be paid in January. Now you'll notice I didn't tell you what kind of expenses they were, right? For the purpose of this question, it doesn't matter. The point is they have expenses. So if they have expenses, we have to record those expenses. We are going to have to debit those expenses. Right? Remember, expenses always increasing, always debited. Okay, now these expenses are not going to be paid until January. So does that mean I'm crediting cash? No, not till January. So if we haven't paid them yet, we have to set up that liability accounts payable. And of course, increasing a liability is a credit. So we're going to credit accounts payable. So again, this is another one of those 4 boxes in my little table from last lecture, right? We have expenses, but the payment is coming later. So we record accounts payable. All right, let's look at a very similar one in D. So in D, Betsy has earned $400 of revenues that will be collected next April. So now again, see, we're talking about something happening later. So they have $400 of revenues, but they haven't collected them yet. All right, well, if they've earned the revenues, we have to record the revenues. And revenues, when they increase, are a credit. So we're going to credit revenues, right, for, oh, not $50, for $400. Okay. and they haven't been collected yet, not till next year. So if we haven't collected the revenues, then we are going to debit accounts receivable. Okay. All right, and that was the last box on the little table that I discussed last lecture, right? We had cash before the revenue, and here we have cash after the revenue, cash before the expense, and cash after the expense. So these are 4 typical kinds of adjusting entries that will be made, right? Adjusting for the unearned revenue and the prepaid expenses, and checking for expenses and revenues that we have that the cash hasn't come yet. And we need to make sure that everything has been recorded. All right, now there are some other kinds of adjusting entries as well, right? 2 other kinds that we have learned about. So here, we've learned about salaries. Actually, 3 other kinds that we've learned about. But here are salaries. Now, this is a variation on the expenses and accounts payable. We learned about this last lecture with the salaries. So Betsy pays employees every Friday for the same 5-day work week. And the weekly payroll is $2,500. This year, December 31st falls on a Thursday. Okay, so every Friday the employees get $2,500 of pay, but the year end, December 31st, is a Thursday. And remember, we have to be very careful about splitting the expense between the appropriate time periods. So we need to make sure that Monday, Tuesday, Wednesday, and Thursday, those 4 days, are recorded in December. Whereas the last day, Friday, that's going to be in January. So that will not be recorded yet. We'll wait till January to record that. So what we're going to have to do is record the salary expense for the 4 days that were in December, set up a debit to salary expense, and then credit to salary payable. Now, I put this here for $2,000. Where did that come from? Well, the whole week is $2,500. But they have spent 4 days working in December, Monday, Tuesday, Wednesday, and Thursday. So we have the $2,500 for the whole week divided by 5 days in a work week, multiplied by the 4 days that the employees have worked. All right, now let's try something else that we talked about a couple of lectures ago. We'll talk about supplies. Now, if you remember, supplies are also an adjusting entry. Supplies are something that we basically ignore, and then at the end of the year, we see how much are left and figure out how much expense we need to record, right? So this is what's happening with Betsy. At December 31st, the unadjusted balance in the supplies account is $350, but supplies on hand are $200. Okay, now remember, supplies on hand at December 31st, those are the ending supplies. So we have $350 in the supplies account, but the actual amount that we've counted that is actually there at the end of the year is $200. So which amount are we going to want for supplies on the balance sheet? Right? Well, $200 is clearly the more accurate number. Right? That's the amount that we've actually looked at and physically verified. So that's the amount we're going to have for supplies in the account. So if we look at the supplies T account, right, we have $350 as the unadjusted balance. Now remember, balance means total. Unadjusted means before the adjusting entry. Right? The adjusting entry, that's what we're about to do. All this stuff, all these entries in the question so far, they are adjusting entries at the end of the year. So we're about to make that adjusting entry. Before we make that entry, the balance, the unadjusted balance is $350. So that's where this comes from. Now, the supplies on hand, the actual supplies we have are $200. So that's what we want the total to be. So how do we get from 350 to 200, right? We're going to have to put some number here over on the credit side. And mathematically, hopefully you can figure out, that is going to be $150. Okay? And why did the supplies go down? Because they were used, right? That's the amount of supplies that were used. Now, if you want to do this question like we did last time, we said that the supplies expense is the beginning supplies plus the purchases minus the ending supplies. So here, this $350, that's the beginning supplies plus the purchases, right? This is what we had in supplies before we did anything. And then we subtract the ending supplies to give us supplies expense, right? So mathematically, it's the same. Just here, I drew it in the T account, but it's the same math. Okay, so you can use the formula or you can look at the T account. Okay, either way, we have determined that $150 of supplies were used. That means we have $150 of supplies expense. And like all the other expenses, right, the expense is debited. And the credit, well, we see it right here, right? When we use up supplies, supplies goes down. So that 150 here, that's the 150 that we credit supplies here. So this is our adjusting entry. All right, that's all of the stuff that we talked about in previous classes. Let's talk about the last kind of adjusting entry that we learned about today. G, machinery was purchased at the beginning of the previous year for $8,000, and the machinery's useful life is 5 years. Okay, that's nice, but it happened last year. Why do we care now? All right, well, the reason we care is because that machinery is being used over 5 years, which includes this year. So we are going to have to make an adjusting entry to record depreciation at the end of the year, at December 31st. All right, so if you remember, the formula to calculate the annual depreciation expense is the cost of the asset divided by the years of life. So if we put in the numbers from this question, we know that the cost of the machinery was $8,000. We know it has a 5-year life, so that will be $1,600 per year. So we're going to record depreciation expense. And like all of the other expenses, the depreciation expense is debited. So we'll debit depreciation expense for $1,600. The credit is the other depreciation account, the other one that we learned about, which is accumulated depreciation. Right? So this is our journal entry for depreciation at the end of the year. All right, one last question I want to ask before we finish with this example. All right, and for H, in G, what is the machinery's net book value at December 31st? All right, so remember the net book value, right? We talked about it back up here. We said the net book value is the net value of the asset, and that is its cost minus the accumulated depreciation. So the net book value is the cost minus the accumulated depreciation. Okay, so we know what the cost is, it's $8,000, but what is the accumulated depreciation, right? That's all of the depreciation that has ever been taken so far. Well, we know that the machinery has been used for 2 years because it was purchased at the beginning of last year. So we have last year and this year, 2 years worth of use. So the accumulated depreciation is going to be the $1,600, right, times the 2 years of use. So we're going to have $3,200 of accumulated depreciation. So to calculate the net book value, we're going to take the cost of $8,000, subtract the accumulated depreciation of $3,200, and that will give us a net book value, or machinery net, of $4,800. All right, so these are all the different types of adjusting entries, right? This example covered the whole gamut. We can adjust unearned revenue, we can adjust prepaid expenses, We can record expenses or revenues that were previously not set up, right? That haven't been put in yet, where we haven't had the cash. And as a variation on those payables, right, we can have salary that needs to be recorded. As a variation on the prepaid expenses, we have issues with supplies where we buy the supplies in advance and then use them up later. And then we can also have depreciation. Right? So those are the adjusting entries. And the test is in a week. So those are the kinds of adjusting entries you can expect to see on the test. Now, I know when I say test, people get nervous. So let's do another example, right? Let's talk a little more about these adjusting entries. All right. So here, example 3. Carson Apartments rents housing units to college students. Carson's December 31st year-end trial balance before adjustments is. All right, so here is the trial balance. Remember, the trial balance is not a formal financial statement. This is just the thing that companies use on a daily basis to have information so they can do their jobs and make decisions. Now, this is the trial balance before adjustments, also known as the unadjusted trial balance, right? Unadjusted before adjustments. Adjusted would be after adjustments. So this is unadjusted. All right. Now, here's their trial balance. You'll notice in your T account sheet that you have, right, here we are, there are numbers in these T accounts already. Why are there numbers in the T accounts? Well, they're the numbers from the trial balance here, right? These are the numbers that have been there because this is what the company did during the year, right? They did all the regular stuff like earning revenue and collecting on receivables and having expenses. All that regular stuff has been happening, and this is the result of all that. These are the numbers they have so far. We just need to make those final adjustments to get them ready for the financial statements. So these numbers that they have so far, that's what's already in these accounts, right? So it's just literally copied over. We have 32,650 for cash in the debit column. Well, that's what we see here in the cash T account. All right, so what we are going to have to do is we're going to journalize, make a journal entry, and post, means put it in the T accounts. We're going to journalize and post the adjusting entries. All right, so let's start with the first one. Only $2,000 of the unearned rent revenue remains unearned. All right, so let's look at the T account here. So unearned rent revenue, here we have it. Okay, there's $6,000 in there. And the question says that only $2,000 remains unearned. So what does that mean? It means that there's $2,000 left, right? So it means that there's $2,000 here in the account. All right, so what happened to the rest of this $6,000? Well, clearly it got taken away because it got earned. So we're going to have to figure out, there's simple algebra, what's the difference here? How do you get from 6 to 2? We are going to have to debit the unearned rent revenue for $4,000. And I'm referencing that as A because that's the transaction. Okay, so we're going to have to debit the unearned rent revenue by $4,000. Okay, so let's put that in our journal entry. Okay, now what's the credit? If I am decreasing my unearned amount, that's because I'm earning the revenue. So the credit is the service revenue or the rent revenue that I have earned. Okay, so that means in the T accounts, we are going to have to go to the rent revenue and we're going to credit $4,000 and put that in there. Okay, let's try another adjusting entry. So if I go here, B, depreciation on the apartment building is $5,000 for the year. All right, so we don't have to worry about calculating it. We've already been given the amount of depreciation. So we're going to have to record depreciation expense. So I'm going to debit an expense, debit depreciation expense, and then the credit goes to the other depreciation account, which is accumulated depreciation. So put that in there, credit to accumulated depreciation. All right, so now I need to post that here into my T accounts. So we have a debit of $5,000 for depreciation expense, and we have a credit of $5,000 to accumulated depreciation. All right, now let's go to the next adjusting entry, C. Employees earn salaries of $1,500 that have not been paid. Okay, so if the employees have salary, that means we have, as a company, we have salary expense. And it hasn't been paid, so that means we have salary payable. So we're going to think about it. Which one's the debit? The expense is the debit, right? Expenses are debited, and then a credit to the payable because we're increasing a liability. So they've earned the salaries, that means we have salaries expense, and we haven't paid it, so we have the payable. So here in the T accounts, I'm going to have a debit of $1,500 to salary expense, and I'm going to have a credit of $1,500 to salary payable. And for some reason that says E instead of C. Let's fix that so that when you look at this later, it's got the right one on there. Okay. Next question. D. $400 of supplies has been used. Okay, so $400 has been used. So what does that mean? If we've used up the supplies, we're going to have an expense, a supplies expense. And of course, because the supplies have been used up, that means we're going to be decreasing the supplies as well. All right, which one's going to be the debit? Well, again, the expenses are debited. So we're going to debit supplies expense and credit or decrease supplies. Okay. So we have $400 debited to supplies expense and $400 credited to supplies. So let's copy that in. So $400 debited to supplies expense, and then we're going to have $400 credited to supplies. All right. And we have one more adjusting journal entry we're going to do. E. On September 30th, $1,000 of insurance costs were prepaid for the next 4 months of coverage. No adjustment has been made since. Okay, so we prepaid $1,000 at the end of September, and now it's December 31st. Remember, like all these questions, right? We're looking at the year end at December 31st. That's when we do our adjusting entries. Okay, so what has happened? Well, September was over when we did this, but October, November, and December have passed. And so we've used up some of that prepayment. All right, when we use up something, we have an expense. And in this case, because it relates to insurance, we're going to have insurance expense. So we're going to debit an expense, debit insurance expense. The credit is to decrease the prepayment asset, right? To decrease the prepaid insurance. So we're going to have a debit to insurance expense and a credit to prepaid insurance, to the prepaid expense. Now, how did I come up with $750? Well, I took the $1,000 of total amount, and that was for 4 months, but only 3 months have been used, right? October, November, December. September doesn't count because it was on September 30th, right? September was already over at the time we did this. So it's just the 3 months. Okay. So now we have to go post that to the T accounts. So we have a debit to insurance expense of $750. And then we have a credit to prepaid insurance of $750. All right, so these are the adjusting entries, right? Previous to the beginning of the question, previously, the company had already done all those regular entries, the ones we started learning about at the beginning of the course. But at the end of the year, they had to adjust just to make sure everything is perfect, everything is right, and they did these adjusting entries. Now, I know the questions here, these individual transactions, were worded a little differently from the previous example, but I want you to notice that the setup of the entries is still very, very similar, right? So here, we are debiting unearned revenue and crediting the service revenue. What do we do in Betsy's situation, right? We debited an unearned revenue and credited the service revenue. It's the same entry. The number was different because we had a different situation, but the setup of the entry, the accounts involved, what's being debited and credited were the same. We are adjusting for revenue that was unearned that has now been earned. I can reword the question any number of ways, but the truth is we earned some of our unearned revenue, and that's the entry we use to record it. When we see that down here, same thing. That's the entry we use to record the unearned revenue being earned. Okay. Same again with the depreciation, right? Whenever we record depreciation, we are always going to debit depreciation expense and credit accumulated depreciation. And that's exactly what we did over here too. Same thing. For the salary, right? We record the salary piece at the end of the year that hasn't been paid. We debit the salary expense and credit the salary payable. And again, that's what we did here in the previous example, right? So the question may be worded a little differently, but it's the same thing that is happening. Okay? And again, with the supplies, we're recording the supplies that have been used. So we're going to debit the supplies expense and credit supplies. We can see that here. Same thing. Right? And then lastly here with the prepayment, when we have prepaid expenses and we adjust to show that some of the prepaid has been used, we debit the expense and credit the prepaid. And we did the same thing back here in the previous question. We debited the expense and credited the prepaid. Right? So these are all the same entries over and over again. So I want you to see the similarities so that when you do a question for homework, right, that it's coming in, that it is making sense. All right, now the last thing that we need to do here is we need to add up all of the T accounts. So I'm just going to get everything here. And whoops, I'm going to add it all up. Okay, and obviously that did not work, so let's try it one more time. All right, there we go. We have totals. Okay, so some of the totals, those are going to be pretty easy. So here, like for depreciation expense, right, the total is going to be just the one number. Something where we have two accounts or two numbers on the same side, right? We're going to add those numbers together. So supplies expense is 625 plus 400 is 1,025, right? And then same here with the salary expense, where we're going to have the 16,500 plus 1,500 is 18,000, right? Same with the insurance expense. Here with the rent revenue, same thing, but on the credit side, 55,000 plus 4,000 is 59,000. When we have numbers that are on opposite sides, right? Of course, we're going to subtract. So 6,000 minus 4,000 is 2,000. Okay. All right, and same with the supplies here. We had it over there with the supplies. 900 minus 400 leaves 500 left. And with the prepaid insurance, 1,000 minus 750 leaves 250 left. All right, the numbers we started with, the ones here at the top, those were the unadjusted numbers. The numbers at the end are the adjusted numbers because they're after the adjusting entries. Okay. So these adjusted numbers, those are what will go to the financial statements. So once we've adjusted everything and we have our final numbers, which is what we just did here, we got those final numbers, then we're going to prepare financial statements. And that's what we're going to talk about next lecture, is how we prepare the financial statements and how we get all this stuff ready for next year so that next year we can start over again. Okay, so the homework for this class, and this is due on Thursday because of the upcoming test. We want the homework done before so you can get answers for it for studying. So the homework is going to be Chapter 2, questions 4, 6, 7, and 8. I know that looks like a lot. It's a lot of practice on these adjusting entries to get you comfortable with that, and a little bit on depreciation. So that will be due Thursday, then you can have the answers before the test. And then next lecture, we'll just finish this up and say, okay, how do we make the financial statements from this, and then prepare everything for next year to start over again. Until then, stay healthy.